companies may be more transparent than their private counterparts when it comes to quarterly profits, but that doesn't necessarily mean what you see is what you get. And joining us now is Jeff Middleswart. He's the director of research at Behind the Numbers. This is an independent research firm that specializes in reading between the lines, if you will, of company earnings for institutional investors as well as hedge funds. Jeff, thanks so much for joining us here today. And let's
Thanks for having me on, Lisa.
Thank you. Well, let's get right into it. You pointed out to me when we spoke last week that a number of companies are facing higher material costs, but some are managing their inventory in a way to sort of hide that.
Oh, definitely. I mean, you've got, it's not news to anybody that grains are up, that oil is up, that metals have been rising again. And what you have is a lot of companies that have simply chosen not to repurchase inventory at this higher price. So you're seeing a situation where, let's say they sell 10 units, they might only buy back 6, or they might only buy back 3. So they're working off their lower cost inventory.
And these are the companies, just very quickly,
that's like a Heinz.
This would be like a Heinz. You pointed out Procter & Gamble.
Mm-hmm. And I mean, both Heinz and Procter & Gamble have the same situation. They're simply burning off their lower cost inventory, which is keeping their margins higher than what they would be if they were selling, if they were replacing inventories at the same rate based on the higher cost. What you're going to see going forward is eventually they'll hit the wall where they won't be able to sell just their lower stuff, and they're going to have to replace inventories at higher and higher cost. That's going to consume more cash flow, and that's going to hurt their margins going forward. At the same point, you've also got a lot of these same companies are also facing pricing pressure because consumers are still not paying up for price hikes. So Walmart, Kroger, a lot of these kind of companies are pushing back on any type of price increase. So you should see weaker pricing power for all these companies. They've all reported that, and you're going to see higher cost structures. You
know, Jeff, we were just talking about some games that can be played with inventory. Stocks you say maybe are primed for a sell-off are H.J. Heinz, Procter & Gamble, and CarMax. Let's talk about another company now, and correct me if I'm not mispronouncing this. Perrigo. I know these guys manufacture store brand over-the-counter pharmaceuticals. They work with large companies, right? This is like an Albertsons, CVS, as well as Target. You say they fall into a category where they're really pumping up their growth through acquisitions.
Right. Perrigo is a company that does a lot of generic over-the-counter type drugs. One of their biggest products is Prilosec for OTC. And what they do is they do a lot of growth through acquisition by buying up smaller drug companies and adding them to their product mix. And what they've done over the years, as anybody that's ever gone through the CFA program knows, that the answer is always do a deal, regardless of cost or any other thing that they play with. So what they do is try and massage the return on capital assumptions when they get it done. And the way you do that is you amortize its assets over a much longer period of time. And so in the case of a Perrigo, they were doing deals, 5 years ago, 6 years ago, where they would amortize the acquired assets and the intangible assets over a 3 to 5 year period.
And you said this adds to their bottom line by amortizing over 20 years. How much does it actually add to their earnings?
It's inflating their earnings about 8 to 10% right now because they've stretched the lives of these assets so much further out. And that's sort of an inherent issue with this company. They've even gotten to the point now where they've announced that obviously they'll still report SEC earnings in their 10Q and 10Ks, but they said that they're going to release earnings without amortization expense at all and trying to ignore all of the acquisition costs.
It's surprising other people don't catch this because this stock, the total return on this stock's worth noting. It's up about 70% just in the last year. Now let's talk very quickly about depreciation. Do you prefer UPS versus FedEx? These are two companies that have a lot of hardware, so to speak, that they have to depreciate over a long period of time.
We would look at FedEx over UPS, even today. And the big issue here again is depreciation. What we found is that UPS cut back a lot on capital spending during the recession versus FedEx, and as a result, they have older assets, which by itself will take their depreciation number down. On top of that, they amortize and depreciate over a longer period of time. So trucks, they depreciate over about 3 years longer than FedEx. They extended the lives of their airplanes from 20 years to 30 years in the last year and a half or so. And what you're going to see going forward is while UPS has a higher earnings quality, or they're generating about another 8 to 10% of their earnings as a result of the higher or lower depreciation and longer depreciation lives. In the future, they're going to be a company that will have to devote a lot of cash flow to rebuilding their fleets. Okay. And FedEx has basically kept theirs up. So FedEx will be a higher cash flow story for investors going forward.
All right. And then this next company, Kraft, it's a big one. And you say there's no single way to categorize what it's doing to its bottom lines. It's got a lot of problems.
Yeah, I mean, Kraft is a company everybody always likes because it pays a nice dividend. They see the cost cutting coming with Cadbury's merger and that type of thing. I look at Kraft as a company that's basically been in long-term decline for years. This is a company that has seen private label and store brand and other labeled companies in the food business take market share from them. They've always tried to grow by increasing price every year, and it's just not working. Over the last 10, 15 years, you can see the squeeze in Kraft. This is a company that's been restructuring for 10 years. When they started restructuring, they had operating margins of almost 20%. Their margins now are around 10%. That's after restructuring with billions and billions of dollars. Cadbury has been restructuring for 10 years. Now they claim they're going to merge the two of them together and they're going to find lots of synergies. I don't know what else you're going to cut.
All right.
And the big thing with Kraft, to me, is not only does it have a lot of debt, its cash needs are rising. I mean, they're spending more on advertising now. They have a pension issue. They have CapEx stuff that they still have to pay for. It's a company that, if you look at the dividend, that's their big source of cash that they're going to need at some point to pay back their debt. And it sort of had everything worked in its favor in 2009. They had commodity prices go through the floor, but their price hikes came through at the end of 2008 and into 2009. So you had 1 year of really high margin. The cost of advertising was very low. That is now rebounded.
Hey, Jeff.
And you're seeing pricing pushback.
Jeff Middleswart, Director of Research at Behind the Numbers, thank you so much for pointing out these red flags to us. It's hard to believe many of these stocks are up double digits since the beginning of the year. Hard to believe that a lot of analysts miss these red flags, and a lot of investors do as well. Thanks so much for joining us today. Again, Jeff Middleswart, Director of Research at Behind the Numbers.